Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates. The Fed speak took some attention yesterday with Fed member Bostic saying that there is no more need of rate hikes. Of course, this is a little contradictory to the dot plots and the estimates by the Fed, but possibly the best steepening situation we have seen naturally tightened financial conditions. Morning, JK. I'm keen to hear your thoughts on the markets right now.
Good morning, Swaraj. Yes, US markets actually opened after a long weekend and ready to react to negative news of the war in the Middle East over the weekend. But there was a barrage of comments from Fed officials indicating dovishness. And definitely, it smacks of official verbal intervention to see that the markets don't, collapse or create some sort of a negative sentiment after the weekend event. And maybe there might be some possible direct action in the securities market as well, because the yields came down substantially again. In fact, as you said, Mr. Bostic was very vocal, saying that there may not be any need to raise rates again. That was sufficient for the markets to take a cue and rally across the sectors. In fact, on the Asian side, we did have a very cautious and weak sentiment after Country Garden, China's largest private developer, warned of a potential default on its international debts in a significant blow to the country's property sector. They are running about 200 billion of liabilities and 10 billion in dollar denominated debt. But subsequently, China's reported plan to spend about 1 trillion yuan or $137 billion of additional fiscal spending to support the economy actually gave the sentiment a boost. In fact, that also saw all the Asian markets, right from Japan, rally, and then spilled over into the European markets. So we did have the US markets close 0.5% higher in all the major indices. The global composite index rally 1%, and the European markets are up by a whopping 2% actually, and that was quite a good performance considering the situation that we are in. We also had IMF statement saying that yes, likelihood of a soft landing has increased for the global growth, although the forecast for the growth itself is lower, but they're probably not going to be a very soft landing. And so these are the supportive factors on the market. And in the securities market, it was the turn of the shorter tenor, the 2-year particularly, to take a tumble after 10 and 30 years had dropped nearly 0.25% from their peaks seen after the monthly jobs report. The 2-year is now trading at 4.92% after having seen 5.20% in this cycle and 5.15% post NFB. So buying into the bonds which had emerged as safe haven due to war situation has seen some intensifying action. And in fact, the Eurozone officials have also been indicating recently that the rate hike in September was the peak for now, which supported even the Eurozone bonds to rally or the yields to come down. The dovish Fed official comments and improved risk sentiment helped further correction in the dollar index, with euro leading the recovery above 1.06. However, the single currency does face a strong resistance at 1.063050, which was the breakdown level. GBP, of course, continues to perform better, and it has already bounced more than 2% low, from the low of last week. The yen, which remains in a focus of the markets because of fears of intervention, and then subsequently expectation of safe haven buying, but neither did happen, and the yen continues to range between 148.5 and 149.20, and does not look like moving out of this range because of the yield difference that the yen faces against the US, and also improved risk sentiment obviously supporting it. The commodity currencies have been on a roll ever since the jobs jobs report was interpreted differently, and also with the oil rallying once again. Chinese plans to spend more for the economy also aided the commodity currencies. Of course, the currencies will likely range ahead of the key data of CPI tomorrow. PPI and Fed minutes will be published today. On the CPI, of course, we have expectation of a lower number across both core and headline, so that can be an added boost to the sentiment for the currencies. On the rupee, of course, none of these have actually impacted, and we've seen again a very narrow range between 83.22 and 83.26. Only triggers that I can foresee for the rupee to move out of this range would be if the war escalates and the oil starts to move up once again, or the bond yields rise above 5% and stays there, and that could be negative for the rupee. But on the positive side, if we do see return of inflows into the market, which we have been missing for a long time, that can be a boost to the rupee. But all in all, we are waiting for some development to see the rupee. Otherwise, it's going to be held in a very narrow range as it has been for quite some time. Thank you.
Thank you, JK. And the one major theme which I'm actually catching from the time we have been doing this podcast is that now global monetary statements for major economies, especially when we see US and EU, have recently uh, showed signs or statements which are saying that the rates have peaked, at least given the current data. So that's a major theme which is coming, that in the developed economies, at least the rates are peaking. Uh, we have got the Fed minutes as well as the PPI data, which will be published today. And for rupee, not much of an impact. We continue to trade in narrow ranges, and we know how much how important flows are, especially for the rupee markets. And bond index inclusion is a major topic of discussion, which has been going on. A lot of articles written about it. But we have got a very interesting webinar coming in, being delivered by former RBI and SEBI member, as well as an eminent economist, tomorrow between 5 p.m. to 6 p.m. Again, reiterating why it is important is because traditional media will not cover uh, such thoughts. What former RBI members or SEBI members will think about this inclusion. So this kind of perspective is unique, and do tune in tomorrow between 5 p.m. to 6 p.m. The link is in the description. That's it for us from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.